Okay, so those are changes that you're going to see in the MSCI and the likely impact on all of those stock prices. Well, Pankaj Pandey is also now joining us. Good morning. So we're talking, it's Friday the 13th, a day after the government revealed the ugliest number for inflation in 8 years. Yesterday we saw FII sell 5,000 crore rupees plus. We've also seen the Nifty give up on 16,000. Bank Nifty came under big pressure, a carnage that we've been seeing in the small caps as well as mid caps. Pankaj, before we get sector specific and stock specific, first up, what is the largest strategy that you folks are recommending when it comes to the equity markets? It's got all the makings right now of a bear market trap. Is it too late to take money off the table?
Hi, good morning. Thanks for having me. I think overall the challenges on the inflation, whether we look at domestically or globally, is still sort of persisting, and which is why hawkishness is expected both globally and domestically. But what we have seen is that the kind of price decline we have seen even for sectors where our sense is that things may not be that damaging. I think those are the pockets what one can look at, primarily IT as well as banking. Overall, our sense is that given this kind of a volatility, it is very difficult to sort of look at shorts at this point in time. And overall, our sense is that with the kind of decline what we've seen, a relief bounce is what we are expecting. Though it hasn't really panned out yet, but our sense is that with the kind of damage what we've seen, whether it is a large cap, mid cap, or small cap, irrespective of the kind of numbers companies have thrown, uh, 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 the kind of subduedness what you're seeing is fairly high. So our sense is that any kind of a positive trigger in terms of commodity decline or a change of stance, the way Bank of England has also has sort of taken a slightly divergent route in terms of because they were the initial ones to sort of go in for a hike in rates. So, because somewhere down the line, it is also expected that the growth is going to get challenged, or you might see recession in some pockets globally. Not as the case with India, but overall, our sense is that probably rather than sort of taking an extreme view, I think the overall central governors might take a slightly more balanced view, given the fact that the growth is going to be damaged in some pockets.
Right, so that's the overall strategy, for you folks have as far as the equity markets go. Kunal, one thing I wanted to ask you about was the bank nifty. Today, we will see a lot of bank numbers out, including those of SBI when it comes to its earnings. Bank Nifty was down over 3% in trade yesterday. What would your strategy be today for Bank Nifty?
So, Mehta, I would probably look at for Bank Nifty as more of a short covering candidate. Over the last 5 or 6 days, when I would say the initial part of the last 5-6 trading sessions, we've seen that the Bank Nifty remained more range bound. Yesterday, when we saw the Bank Nifty going down, there was mild bit of covering of short positions. So just about some 2% or 3% reduction in terms of open interest, which means that in the last 4 or 5 days there have been a lot of shorts which have been built into the banking index. But it was just yesterday where you saw the Bank Nifty underperforming and falling sharply. When I look at it relatively, so when we try and compare the Nifty performance and the Bank Nifty performance, Nifty is it managed to be just about at 0.5% or 0.8% of the previous lows which we had hit in the month of Feb. That's around 15,650, 670 mark on the Nifty, and Bank Nifty is still up by almost 1200 or 1300 points above the Feb lows. So when I look at it relatively, there is a stronger degree of outperformance already built in on the banking index, and I think that's what is the key to take note of, because when you have the benchmark Nifty falling and the Bank Nifty on a net basis remains more resilient, we look at that as an outperforming sector. Now the question is that which sectors, which stocks within the banking index one needs to look out for, because I would believe that the private sector banks and the most stronger and the sturdier ones, they could be at the forefront of some bit of short covering or long built up. So names like Kotak Bank, Axis Bank, I would probably put even HDFC Bank. These could be possible candidates of a strong turnaround, and possibly I think even SBI. The stock has been just meandering at that 470 mark. I believe that the stock should come back towards its mean at least. But the mid tier private sector banks as well as the mid cap PSU banks, that's not something which I would probably look out for in the first attempt of this market rally. But I believe yes, the large cap private sector banks, they bought a good buy even at current levels.
Hmm. Kunal, in the morning we were marking as to how the S&P 500 index has already fallen 20% and it's already in bear market territory. Given that we have fallen a lot less, although today we may be playing in for a rebound, just wanted to understand if you've drawn up any correlation between the S&P and our markets, and does it seem like we could be headed in for that quantum of a fall or not?
Well, Aisha, very very tough to say because it's so the reason why I say it's very tough because it's a cause and effect. Now we need to see that whether the cause is more with respect to what's happening across the globe and especially the US markets where the liquidity has been sucked up significantly and you see some the expectation is of strong interest rate hikes going forward over the rest of the year as well. So if that's the case, then of course that the markets would get into more of a risk aversion mode, and in that risk aversion it's a sell off which happens across the asset class, as well as not just about asset classes but across equities across the globe as well. So that's, I think that's something to watch out for as a phenomena. Now the first phase of the sell off is of course very brutal, but then the rally as well has to be seen in the similar context, that whether we are seeing a rally across various asset classes. So this time when you're seeing in the last 10-15 days or the last 2 months of price action, it's not just that equities have been I would say clobbered over the last 10-15 days, but it's across the asset class. You've seen gold not performing, silver has dropped down, you've seen commodities also falling in the last one and a half odd month, equities across the globe has fallen down, and cryptos as well. We all know what's happening over there as well. So it's a sell-off which is across the asset class. We need to see how the bounce shapes up, which are the asset classes which tend to turn around, where is the trend going to sustain next. So I think that would probably determine that how we move ahead. I will also like to draw a very parallel for the market say in 2003 2008. In those kind of a time span, there were many periods, or in fact two periods, where I distinctly remember that the markets were down below the 20%. So we had sharp corrections in those time span as well, but the markets went into a V-shaped recovery. Now of course those have been very historical contexts, but we'll need to see that whether we fall into a very similar kind of a category of a V-shaped recovery, or we go into a gradual process of stabilization and then let the asset classes across the globe recover. That would be a more prudent time to take a decision.
Sure, makes sense. Pankaj Pandey, the other thing I wanted to talk about was what happens within the IT sector now. I recall that year end or January onwards, you had that big NASDAQ crash play out, which rubbed off on our IT stocks as well. The start of this quarter, again, you had some disappointments coming in from Infosys, etc. And again, the IT stocks fell, though not as much as they did year end. Having said that, have they fallen enough to be bought again?
I think besides banking, IT is another sector which can be looked at because our sense is that the risk reward is quite good. When you look at tier one names like Infy and TCS, say for example, Infy is trading below 24 times forward basis. And most of your tier one or tier two IT companies, we have seen total contract values jumping up. It is just that the attrition is high, and which is why you are seeing more of a margin pressure, which our sense is that going forward, overall, it may not really damage, it might sort of delay the growth, but it may not really damage the overall growth. And I think our sense is that overall within the entire segments, this is one sector which will be least impacted by inflation or the kind of logistical issues which some of the other sectors could face. So from that perspective, I think IT and banking are the two sectors which are looking good from a risk reward perspective, and we like most of the tier one names post corrections in the IT space.
Bufa ML coming out with its latest note on L&T post its quarterly performance. They maintain a buy with the target price at 1806, saying that it's been a robust beat when it comes to the order inflows. The Hyderabad metro plan coming out of that de-risking is going to be a huge positive trigger. They've unveiled a very ambitious 5-year plan as well, and they see exits from a lot of those heavy business like Nabha Power Plant and the road SPVs as a huge positive, with robust guidance and valuations re-rating. Pankaj, wanted to get in your take for an investor who's been patiently holding on to L&T. After reading into these numbers, very ambitious forward-looking statements. What's your take?
So previously we had a buy rating on the stock, largely we'll be maintaining, but I think when we look at overall order inflows have been good, but I think there's a bit of a disappointment on the margin front. The standalone margins are down, so we were expecting closer to 12% kind of a margin, and the margins are lower. So, and going forward with the inflationary pressures seen, our sense is that it will be very difficult for margins to improve, and which is why the stock has been sort of underperforming till the time we don't see commodities or input prices sort of cooling off. Despite higher order inflows or despite better growth, I would not expect LNT to sort of outperform, though we still believe that this stock can be bought. But I think till the time commodities don't cool off, the pressure on the margins may not sort of come up, and which is why I think things are challenging. But even similar was the case with even with NCC. So, which is where I think our sense is that higher inflationary pressure will continue to sort of dampen the overall price performance.
Okay, so margin pressure is going to be the stumbling block when it comes to L&T, and until those pressures don't ease off, perhaps the view doesn't change or the stock is not going to see an incremental move. But let's also hear it out then from Devang Mehta of Centrum Wealth Management, who shares his top sectors that he is bullish on.
On long term, if I can talk more about a sector. We've been very bullish on building materials. And again, as I say, these are times when one probably is tested in terms of raw material costs. So one show the numbers of Asian Paints or companies like even Pidilite, or companies in the I can say universe of electrical goods companies like Havells, Polycab. I think there is a big theme playing out here. Not only the real estate cycle has sort of improved, but even the home improvement or a home refurbishment theme, which lied low for the last couple of years, that has also come out. And I think people want sort of branded goods, even in terms of not only paints, but also in terms of electrical goods and such fittings and ceramics. I feel this as a sector probably would get re-rated as a proxy play for real estate as well as for home improvement. My sense is one should probably have certain picks over here. The companies that I named, we own in a lot of our client portfolios. So with a disclaimer that we own it in our client portfolios, these are certain companies which one should look at. And as a little bit of a contra theme, we've been very bullish on insurance. Yes, of course, the last couple of years we have lagged the market because of the claims that emerged out of death claims in terms of life insurance and mediclaim claims in terms of your general insurance companies like ICICI Lombard. But I think probably if we are calling this an endemic in India, in the next 3 to 6 months, the profit pool will rise brilliantly. And that's where the base of a lot of these companies in terms of profits, because claims were roughly, HDFC Life itself had claims of 4,400 crores. So this all would sort of vanish. The top lines are growing, bottom lines would start sort of expanding. So these two themes, I think, would be sort of flag bearers for us.
Pankaj Pandey, I wanted to ask you about Tata Motors. This is a stock that you've seen trade off. There are views there that, this could be a stock to watch out for the next 30 days, especially after the earnings that we have actually seen. Free cash flows going up, losses that are widening, good guidance also for the new financial year.
In the auto OEMs, I think Tata Motors and Mahindra are looking particularly good. The rest of the other players cannot or should not be sort of chased. That is our view. And for Tata Motors, we are seeing quarter-on-quarter margin improvement across whether it is PV business or CV business. And with the kind of line of what they've done, especially on the PV side and the overall tilt towards EV side, our sense is that the kind of price correction or price damage what we have seen in this stock is available at a good risk reward perspective, and should be bought. And I think overall auto relatively looks better compared to the rest of the market, because this is one pack which hasn't really sort of performed for a good period of time. And also on the CV side, our sense is that after 3 years of sort of underperformance, CV cycle is about to sort of see an upturn, and of which Tata Motors ideally should be a beneficiary, given the fact that they have about 45% kind of a market share. So I think it's a sort of a good stock available post correction with a better risk reward ratio.
Okay, so that's your call as far as Tata Motors go. I'm going to shift gears now and get you one of the top voices from India Inc. It is Sunil Bharti Mittal, who at an event organized by the CII, the industry body, talked about Airtel's next gen businesses, from Wink Music to other new age segments, even if it's to do with advertising and how a full stack is being created. Make use of a super app. Listen in.
Today, Airtel's balance sheet is healthy, it's strong, and we are now down to two and a half players for a country the size of India. So future looks good now. Now, will there be one more crisis many years going ahead? Who knows? But this company has become very, very strong and battle hardened. Our digital revenues should start to become meaningful in their own right in several billion dollars over the next few years. And thankfully, the valuations or the multiples that one generates in the digital business, because the capex is low, is significantly better than telecom, which is a very solid business, but a capital guzzling business and a spectrum guzzling business every year will be a good combination to have in the group.
Okay, let's talk about what the trading setup is looking like. Well, today, of course, we're playing for a bit of a rebound. Looking at the Asian screen, it seems like a bit of a relief. But talk about, trade yesterday, and banks clearly took it on the chin. Names like PNB reacted to their numbers, and PNB lost about almost 14%. It was no different for a federal bank or an RBL bank. Both those names fell by about 6% apiece. IndusInd Bank, amongst the large caps as well, was down about almost 6%. Naresh, we were chatting with Kunal about his thoughts on banks before you joined in. Just wanted to understand, where within banks would you initiate fresh shorts, if at all?
So, would not be initiating fresh shorts in banks because if you look at the large cap banks, they are back to 1 year lows. And if you look at the small cap banks, they've corrected 40-50% from their highs in January 21. Some of them are available in June 2020 prices. So at these prices, the risk reward is terribly bad for a shorting trade. So if I take the worst one also, RBL Bank, the stock has corrected from in the long run. If you look at it, the top was around closer to 650 levels and the stock is at 100. Pre-COVID, the stock used to be 300 odd. So at these prices, it's extremely difficult to take a short trade with a risk reward which is in favor. So the 2020 lows for the stock is closer to 100 where we are today. So in such a scenario, I would be extremely careful taking shorts on the bank Nifty. And if you look at the bank Nifty, it's gone nowhere. Even if we go the pre-COVID highs were closer to 33,000. We are still around that 32. Pre-COVID high was 32,500. We are still around 33,000, 33,500. So the index has gone nowhere in terms of the relative outperformance post-COVID. So at these prices, actually Nifty Bank is the one which can become a leader because it has spent time being an underperformer, hit by COVID and various other things. So I remain more bullish on banks than bearish as such.
Okay, 1% higher, that is what the S6 Nifty is indicating. 172 points up in the green, almost nudging that 16,000 print for us after having knocked down 2.25% in trade yesterday. A 367 point loss. Seems like today we are batting in for some amount of recovery for sure. Kunal, is that your belief as well, that the recovery is going to be led by the most battered and bruised banks, that is?
Well, again, very difficult to say and anticipate, Aisha, because recoveries have two different tinge to themselves. One could be, if confidence comes back in a very similar kind of intensity, then we would see more of, a blend of long covering as well as short built up. Now, if there is rather short covering and long built up. So, if there is long built up, which means there is confidence which comes back into the markets, and that's where the large caps they tend to outperform strongly, because that's where the initial part of the money would flow in. Then the blend would be more of short covering, and those would be the sectors and stocks which have been beaten down significantly. So we can try and look at names like, for example, Voltas. Then you have Tata Motors, L&T. There are many stocks. Bajaj Finance, Bajaj Twins have fallen very sharply in the last. Then small caps and mid caps have also been clobbered quite a lot. So we may probably see some blend of short covering over there as well. So the extent of what plays out is very difficult to anticipate firsthand. We'll have to wait out for at least a couple of days of the markets getting into a stabilization phase. There would be a lot of juggling of portfolios. I think at every bounce as well, there would be more tapering of risk rather than more risk, being taken by the market participants because of the last 10 days of steep market correction. So that balancing act would probably help us determine that which way the market tilt is getting back again, whether the old sectors or the ones which are outperforming since the last wave of the market uptrend, whether they continue to be outperformers or whether the markets are latching on to some new sectors. For example, it could be that the IT stocks which have underperformed over the last 4 months or 5 months of this calendar year, whether the market gets into a tilt where the IT stocks are now become favorite because these stocks have corrected sharply and they are now available at much better valuations or prices, whatever way you look at, or we tilt back towards the old sectors which have been outperforming like the banking or maybe the other stocks like auto, etc. So it's very difficult to anticipate the first hand. Maybe a couple of days of post the markets being stabilized is where we may get a much clearer view.
Okay. You had the telecom data as well, the subscriber data coming out. Bharti Airtel's active subscriber addition has been the highest in the last 12 months. They added 46 lakh active users on their network in the month of March, which is the most as compared to its peers. And Jio, Vodafone, Idea's numbers, as of now, not looking at them very closely because the companies have already reported their Q4 earnings. Pankaj, just wanted to get in a take as to what the outlook is in light of the kind of telecom subscriber data, the earnings that we've seen for telecom companies, the ARPU numbers for the entire telecom basket.
So in telecom, I think you can play only through two stocks, which is Reliance Industries and Bharti Airtel. Now, there has been an improvement in ARPUs for both Bharti Airtel and Reliance Jio. Vodafone is something which we feel will survive but will not do much for the equity shareholders. Now, within the two, our sense is that Reliance has got more triggers in terms of higher GRMs, which is what we have seen for some of the pure refineries like MRPL or Chennai Petro. On top of it, the recovery in the retail side also has been pretty good. At least the exit months of say March or April, the retail recovery has been pretty good. Sum total, Reliance looks like has got more triggers compared to Bharti Airtel. So that will be a preferred one in terms of pecking order. But having said that, overall telecom looks quite attractive to us. I think the only hiccup is that the 5G pricing is still sort of on a higher side from a overall both the companies' perspective. But the companies have been guiding for a tariff hike going forward. So I think that should sort of take care of the challenge. So don't expect a near-term jump, but our sense is that within the risk-reward ratio, I think this segment is still sort of looking good. May not have seen that kind of a price damage the way other pockets have seen.
Let's get in a take, Kunal, then on the charts, how you're looking at autos. Tata Motors, Eicher, by the way, is going to come out with its earnings today. What's the outlook?
So I think there are a few pockets of stocks within the autos which are still resilient. I was looking at, so yes, the tier one names like, Maruti and Eicher Motors, I would say even Bajaj Auto, they have been far more resilient in the last, 3 months of this price action. They've been managing to protect their, 3 month lows for themselves and managed to recover as well quite strongly. So I believe that that pocket of, that pocket within the auto sector, they could manage to bounce back. The other way to look at is names like Ashok Leyland as well. M&M has been a fantastic in a fantastic uptrend in the last 3 months from a base of 720, 730. The stock which was at almost 930, 940 a couple of weeks back has now come back towards the midpoint of this 200-point rally for itself. So that also is a very attractive chart. But the other space within the auto pack is the auto ank, and I think that's where I believe the the higher beta or the higher returns could probably be generated. I think stocks like Apollo Tires, MRF, Balkrishna Industries, the structure of these stocks over the last 3 months have improved significantly. Now, even though these last 10-15 days have been brutal, but we've not seen any major corrections shaping out into these auto ank names, specifically the tire stocks, and I think that's where I believe that there could be a more durable bounce back, which could be seen. So depending on the category of risk profile for each short-term trader, I believe if you're looking out for more slightly lower beta kind of a stocks and more stronger and sturdier ones, large cap ones, then I think Maruti, maybe M&M, these stocks could be preferred candidates for. But for someone who's looking out for more higher beta, I think Apollo Tires and MRF could actually fit well.
Okay, fair enough. That's the view coming in.
Suresh, I'll come to you and Voltas, how to make sense of what's been happening to Voltas, that long unwinding continuing, something that we could also now seeing in Dixon Technology and Birlasoft.
So if you look at most of the stocks which were expensive and the price action has been pretty strong on the downside. So Voltas, for example, there was a whole narrative around the summers, etc. But the price was not able to cross into a new all-time high, stuck there. And there was a big fall post results, and it followed up with a sell below that 1100, 1150 mark. And now for the stock, we are back to the prices where we were in start of 2021. So it's critical that the stock holds on to the 900 mark. So 900 is the make or break level on a weekly sustaining basis. We've come there. 900 was the low in April 21. So 900 is what I would keep a stop loss. The stock is oversold, but one has to have their stop losses in place because when stocks collapse in such a sharp way, it's tough to know where the bottom is in place. So 900 is the strict stop loss here. Dixon Tech, on the other hand, has continued to give a breakdown and the volumes have been large on the downside. So I'll be extremely careful here. I would rather wait out, let it stabilize here, and then maybe whenever it goes above 4,000, that is the place I would participate, not at these prices.
Pankaj Pandey, we've got a big IPO on delivery. 5,200 crore rupee IPO on day 2, only 23% subscribed. You now have a Zomato at 52 rupees a share. You have Paytm, which was again under pressure. Nykaa, that incidentally went home in the green, higher by 3%. My question for you is, the kind of pressure that you're seeing, would you enter these stocks at any of these prices, or because of what's happening in the US, it's pretty clear they're going to go sell off a lot more?
So I think when we look at these stocks, for us, I think profitability or the business model needs to be right. Say, for example, in case of delivery, while the logistic market could be 9.5 lakh crores, but the express segment is somewhere about 18,000 odd crores, expected to go up to somewhere about 70 to 80,000 odd crores. No doubt, company is going to grow at a phenomenal pace. But I think when you're still not making money at the EBITDA level or the profit level, it is very difficult for us to sort of expect the stock to sort of trade at 7 times kind of a multiple. So I think if the overall business dynamics improves in terms of better pricing or EBITDA and the overall profit numbers sort of improving, or there is a visibility of profit, then only I think we are going to sort of chase companies. So which is why largely we have sort of avoided most of the new listings post coverage. I think when you're sort of valuing a company 10 to 20 times forward basis, I think then you cannot, there is a very little, limited scope for getting it wrong. So which is where I think the challenge lies for us. So unless the companies are profitable, we would not be really sort of chasing. I think one company which we have consistently sort of recommended within the listed space is Ease My Trip. I think they've been making profits despite being smaller in size compared to competition. And I think it's a sort of unlocked trade as well. So that is what we have been sort of liking. Besides Star Health is also which we have been liking. So I think these are the two names which we have covered or tracked or are covering at this point in time. Largely, we have been sort of avoiding most of the other names where the story is quite longish in nature, because I think for that to understand, a bit difficult for us.
One can guess that. Pankaj, the other thing I wanted to talk about also was, the LIC IPO. The grey market premium right now is indicating 30 rupees. But just wanted to understand, looking at the market construct, do you think it's going to be challenging to make any IPO pop, which retail investors have been so used to last year?
No, so I cannot really comment specifically on LIC because we are one of the lead managers. But having said that, I think the entire insurance as a space has not really been performing largely because when you look at BFSI plus insurance put together, it does not look like one would want to sort of increase allocation from a portfolio perspective. Which is where if you have new players which will get listed, then the weightages will need to sort of get distributed. So which is where the sort of challenge has been. But of the listed private players, I think SBI Life is sort of doing a lot more better than the rest of the two players. And whether we look at the recent month data as well. So I think that is the company we would prefer in that pecking order. But overall, as a space, we still don't expect this to sort of outperform the market, given the fact that overall allocation, whether we look at BFSI or insurance together, is on a higher side. So I think so that way they could be at best market performers.
Sure. As a strategy, though, Pankaj, are you staying away from the consumption space at large, those maximum impacted by inflation and are unable to pass on the inflation hit onto consumers?
Absolutely. I think when you look at a category like paint, I mean, you had 22% kind of a price hike being taken. Still, the margins haven't really sort of recovered, even for a company like Asian Paints. On top of it, if there is a further hike which is expected, then I think somewhere down the line it could lead to down trading or a lower demand. Similarly, when you look at a category like, say, white good, we are seeing that in AC, like a category where the volume growth is very good, whether you look at for Havels or whether you look at for Voltas, but the companies are competing on prices, which is why you're seeing pressure on the margins. And I think these margin pressures are going to persist for a quarter or two, and which is why probably some of these names could be avoided. But what can be sort of looked at is, say, for example, electrical appliances segment, say, something like Polycab, where our sense is that the numbers are good, the company has been guiding well, and lower electrical appliances are not seeing that kind of a price competition, and plus they've been sort of looking to do capex. So there are some pockets which can be looked at, but largely most of the consumer-oriented categories, I think, can be avoided given the fact that margin pressure could be at elevated levels in the next quarter, and then we need to see whether companies can do price hike and the kind of demand destruction it does.
Naresh, I'd like to come to you about Infosys. Yesterday, what we saw were very high deliveries, the spike as well, 68%. Given the recent underperformance of the IT sector, particularly the blue chips one, how should one see this?
So for Infosys, the last previous top was closer to that 1480, 1500 mark, where it started that move towards 1900. We've come back to those price points. So for now, this is a good support area. So I would keep a stop loss below 1460 and expect a bounce towards 1580, 1600. It's only about 1600 where the momentum changes. So for now, I expect a bounce towards 1600, but over 1600 is where I would get a little bullish on the stock.
Okay, so not quite there yet to sense a turnaround, at least what the charts are indicating as far as Infosys goes. Pankaj Pandey, at this juncture, I'd like to thank you for being live with us today. It's Friday the 13th, but at least looking at the way the rest of Asia is performing in the SGX Nifty, we could see that bounce back that we've all been waiting for. Thanks so much for being live with us. It's also that time of the show, ladies and gentlemen, where we get you ideas from the broader markets. And boy, have we seen the mid caps and small caps come under immense pressure. So, what kind of ideas do our charts have for us this Friday the 13th? Kunal, I'll come to you first.
So, Neta, it's a buy on Jubilant Food, the stock which has been beaten down significantly. Yesterday formed one of the very important candlestick patterns. It's more like a classic bullish hammer pattern on the daily charts for Jubilant Food, and even the volumes data was a bit more encouraging than what it has been over the last 1.5 to 2 months. So, would suggest a buy on Jubilant Food. Targets of 500 on the upside, stop loss at 455.
And Resh, what about you? What's on your radar from the broader markets?
So that would be a buy on Bharat Electronics with a stop loss at 215 and a target price of 250. One of the few stocks just been holding above the breakout points in this market. Most of the stocks have taken a much larger hit. So a good relative strength stock out here. So expecting it to take leadership going forward.
Okay, let's talk about some Dharmaka earnings as well. And Anupam Rasayan is one stock or rather company which came out with a blowout set of numbers. Let me take it across to Sharad, find out what stood out for them this quarter. Sharad?
A strong set of numbers coming in from Anupam Rasayan, with the revenue rising almost 19% while the margins also going up by more than 150 basis points, coming in at 30.7%. The numbers are of course on a sequentially basis, and the results have come above the expectations. The revenue is driven by higher volumes, and even the EPS rose by 22%. But the most important thing is the guidance which we'll be looking at, and the company has stated that they are going to add a new Japanese MNC client in first quarter of FY23, and the revenue visibility is very strong with the LOI contracts as they are being converted into long-term contracts. They are expecting that the next phase of growth would be coming in from their foray in the fluorination business. Now, do remember, this is the fluorination chemistry business has actually started after the company acquired 26% stake in Tanfac, and they are also expecting 6 new molecules to be commercialized in the new FY23, and even the capex plan suggests almost a 2500 crore outflow.
Okay, that's Anupam Rasani. Look out for that stock in trade. Let me also talk about Sun Pharma, and there's a recent note coming in on Sun Pharma. Let me take it across to Pankaj Poddar from our research desk and find out what this new note on Sun Pharma is all about.
So, Aisha, it's an interesting one, and it's not only about the note. Recently we had flagged off the news, and the management had pointed out that Halol facility, which is one of the key facilities of Sun Pharma, has been inspected, and the Form 483 has been issued with 10 observations. Credit Suisse has got access to that, and they have written a note about it. 10 observations came in. There were 2 inspectors and one Indian investigator also came along with that. Areas of observations were towards production system, equipment, laboratory control, as well as quality team. First observation requires changes to pharma's aesthetic process simulation for injectable, and majority of observations pertain to injectable manufacturing. According to them, majority of the observations were on injectable, and that's why they would likely need and re-inspection. Overall, 19 pending complex ANDA as per the last annual report that the company has filed. So this definitely is one of the important plants. Now, some of the key takeaways from the observations which they have written in detail are: inadequate validation of process to manufacture sterile injectable, non-classification of high-risk process posing significant risk to contamination, poor maintenance and sanitization of production equipment, and usage of poorly designed equipment lending to contamination. QC lab failed to test greater than 200 stability samples within the time frame. So not looking that great, but I think the stock has fallen. But they've written about this, talking that what's really happening with the Form 483. It may need a re-inspection, which means that they would have to undergo and re-inspection. But of course, the company has 15 days to reply to this particular Form 483, and a lot depends on the reply of that Form 483.
Okay, so that's what Credit Suisse has to say on Sun Pharma this week. We've seen a lot of these pharma counters in the news, whether it's Cipla for its earnings, or Abind Pharma, which received those 6 observations from the US FDA, and now this as far as Sun Pharma goes. Well, it's 9:05 a.m., ladies and gentlemen. You know what that means. It's time to get to an exclusive story right here on ET Now and on our sister concern, ET Now Swadesh. Today, our exclusive story comes from the oil and gas space, where my colleague Prakash picks up that the oil marketing companies IOC, BPCL and HPCL have approached the Petroleum Ministry saying the business model is no longer sustainable. There has been no hike in petrol and diesel prices for the last 36 days. They've hit the pause button. So what exactly have they told the Petroleum Ministry? And, considering they always say that petrol and diesel is deregulated. Prakash, good morning. What exactly are you picking up?
See, halting petrol diesel price revision has put more pressure on oil marketing companies once again. We have been informed by our sources that the oil marketing companies have approached Petroleum Ministry for its immediate intervention for hiking of prices of petrol and diesel. As per the sources, OMCs are suffering loss of rupees 25 per litre on diesel and rupees 10 per litre on petrol. As you are aware that the prices of petrol and diesel have not been revised by OMCs for last 36 days because of the informal instruction from the government. But our sources in the ministry have said that the oil ministry is in favor of allowing OMCs for hiking of petrol diesel prices. Oil ministry also wants that relief to be given to the consumer by cutting taxes. Center should cut excise duties, and state government should be taken on board for reduction of VAT. It has approached finance ministry for its immediate intervention. As of now, excise duties, that is being collected by the center on petrol is rupees 27.9 per liter, and diesel it is rupees 21.8 per liter. And the states are charging VAT as high as 36%. Now it will be interesting to see as to what will be the future action going forward, especially at a time when the center and the states are blaming each other for current situation.
Right, thanks a lot, Prakash, for joining us live with that. That's the ET Now exclusive. Also on ET Now Swadesh, IOC, BPCL, HPCL raising the red flag, saying not possible to continue like this, not hiked petrol and diesel prices despite what's happening on Main Street with the currency as well as with crude oil prices at large. Now, earlier this week, what we started to see was massive sell-off in stocks that are HNI driven. Look at Ruchi Soya and look at India Bulls Housing Finance. Kunal, but what we saw yesterday was these stock prices trying to recoup the heavy losses from earlier this week. What do you make of that?
So I think it could be more of a temporary bounce in at play for these stocks. They would not be the first ones to try and lead into a market rally. So what happens is Nayantara, when there is such a sharp sell-off into stocks like India Bulls Housing, and when you look at the last 3 months, 6 months, 9 months, 1 year of charts, the stock has been a big underperformer. So the market, the participation levels into these kind of stocks drop significantly. So just as a comparison, day before yesterday when the stock was down some 15% or 20% plus, look at the volumes on that kind of a candle day and look at the volumes comparatively yesterday, even though when the stock was trying to claw back again, closing at the high point of the day up by almost I think 7% or 8% on closing basis. So the volumes were far lower yesterday. So as and now the stock gets into a bounce kind of a phase, the participation level drops significantly. It's just that when the market mood and the sentiment comes back to its earlier levels, that's where you find a lot of participation increasing into these names, and that's where you see more high flying price action. But other than that, I don't believe that they could be the first ones which one should be looking out for in terms of trying to play for a bounce or even a trade over here. I think it's much better to try and concentrate on these quality names, large caps. There are so many sectors and stocks, even on the large cap front. For example, look at Reliance Industries, the stock which was at 2,800 has now come back below the 2,400 mark in just a matter of I think 10, 12 trading sessions. So I believe that the concentration should be more on the large cap names rather than on these mid cap names which are very, very high beta in nature.
Right. Okay, Kunal, stay with us. Let's quickly tell you what both Kunal as well as Nuresh are building in terms of market consensus and what really is the index call. Let's start off with the Nifty, and it's a consensus buy from not just Kunal as well as Nuresh Mirani, but also from CA Rudramurthy, who also has a buy call on the index. Rahul Sharma has got a hold, Kush Bora again a hold, and Gaurav Bisa also a buy. Let's talk about the Nifty Bank, and that's pretty much the same sentiment this morning there as well. You've got Kunal Bothra recommending a buy, Nuresh Mirani also going in for a buy, so is CA Rudramurthy with a buy call. Rahul Sharma recommends holding, Kush Bora again a buy, and so is a buy coming in from Gaurav Bisa too. Okay, a consensus buy not just on the Nifty but on the Nifty Bank as well. We're playing in for a rebound this morning. The SGX Nifty is indicating an uptick of about almost 1.5%. 168 points higher is where it's currently at, 15,976 thereabouts. So still sub the 16K mark, but let's see. Let's hope for a stronger recovery when the market actually opens. The pre-open rates as well holding out quite okay. Of course, we're going to start off with earnings reactions from Tata Motors, from an L&T, and sectorally, given that banks were the most clobbered down yesterday, let's see whether banks actually managed to sail us through or not. Also, what has to be marked is the kind of resilience that you're seeing from the IT pack per se. While yes, they closed in flat and they gave up their gains, but TCS, Wipro, HCL Technologies, all of these stocks were fairly resilient to yesterday's fall. Not just that they were in the green for some part of the trading session yesterday, they fell a lot less as well as opposed to what the rest of the market saw. So Wipro was flat, similar was the case for TCS as well as HCL Technologies too. But of course, on the flip side, not just banks, names like Adani Ports came in hard, about 6.5% lower there. There was also metals under pressure, and big boys like Tata Motors as well, which fell pretty hard. So did Bajaj Finance. So, some of the select blue chips were the ones which really took it on the chin yesterday. But just a minute left to go before we kickstart trade for this morning. Kunal, just wanted to get your sense about the Adani group of names. Given that they were already that rich valued, and given that it's a high beta pocket, pick up any stock from the Adani group. Just wanted to understand that, is it a given that on market decline days these stocks are bound to fall?
So yeah, I think these stocks would be bound to fall because of a lot of juggling, Aisha, because there is a lot of M2M pressure, which happens, and that's why stocks which have been doing reasonably well, they are the ones which tend to see more profit booking. So I believe that that pocket would see more pressure, but I think Adani Ports is one stock which I would be definitely looking out for a reasonable bounce from current levels.
Right. Okay, Kunal, the market opened then this morning. Let's mark the first trades on the Nifty. It's a bit of a sigh of relief to see so much green on the screen actually. We're inching towards that 16K mark. 1.25% higher for the Nifty right now. 15,980 is where we're currently at. Sensex as well holding up 1% as we speak. Nifty Bank scaling higher by 1%. Good market breadth as well. 1,396 stocks standing to the green versus the decline count of 200. Tata Motors, look at the kind of strong recovery after getting beaten down yesterday. 5% higher on Tata Motors as we speak. It's a strong recovery that Tata Motors has made reacting to its earnings. I also want to check in on what L&T is up to and how that stock is currently faring after its numbers. That stock should just come up for you on your screens next. And then of course, today you've got SBI, you've got Tech Mahindra and Eicher Motors, which are slated to report their numbers. Also, Sun Pharma, let's look out for that. We just highlighted what some of the brokerages are saying on Sun Pharma, but they've also got a US FDA approval coming in for a particular generic capsule. So look out for that stock as well. You've got the MSCI additions list, Adani Power, AU Small Finance Bank, Jindal Steel and Power, Tata Elxsi, BOB as well as Cholamandalam. So you're bound to see some inflows and adjustment on the basis of that. Also, the Dharmaka Earnings, Anupam Rasayan, Q4 revenues, they've been higher by about 17% in trade, and the Q4 PAT has jumped twofold, now standing at about 46 odd crore rupees. RBL Bank also came out with its numbers, although the stock was a sharp downtick yesterday, but the Q4 NII has posted an uptick of about 24.8%, and the asset quality also has seen a bit of an improvement in the fourth quarter. I'm just going to refresh my screens and let's see what the F&O rates are looking like. While the index is holding at 15,974, good market breadth. RBL indeed is your top stock reacting to its earnings and also bouncing from an oversold level, 9% higher for RBL as we speak right now. Bharat Forge, Ashok Leyland, AU Small Finance Bank, these are all your winners this morning. Sectorally as well, barring telecom led by Bharti, which is down 0.5%. Rest of it is looking pretty comfortable in trade so far. Nayantara?
Okay, so that's what the first trades are, of course, looking like the movers and trade shakers that we've seen in trade. And Aisha, it's pretty much along expected lines. We've seen what happened, that report card we got overnight, but the way the XGX Nifty are performing and the rest of Asia.
Okay, that's that on the market, but let's welcome on board the gentleman from Girik Capital. We have with us Charandeep Singh as well as